Wasting money on cures. Forgot how to fix myself. They say that time is free. Then why is it so precious? Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. Time is running out. Time is running out. Lately I've lost my track. I've sailed the deeper seas, hoping to find something to bring back better times. Oh, I'll say memories in my head, like Polaroids on walls. They remind you to look ahead. But time is running out. 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 Time is running. Time is running out. But time is running out. What if my best days are over? They can't be over. They can't be over now. Time is running out. What if my best days are over? They can't be over now. Time is running out. Time is running out. Time is running out.
Okay, good morning, everybody. Welcome to the latest in our series of live revision sessions. Key topic revision, the intersection between year 12 and year 13. We take a key topic. This time it's monetary policy, and we have some multiple choice questions and some short answer questions as well. Now, if you're watching live, then you can log in, subscribe, and contribute to the chat window. If you're watching on replay, always just take a moment, press the pause button if you want to spend a bit more time on a question, because we walk through the answer or suggested answers together. Before we get going, a quick reminder that we're on the road. We're going to across the UK, from Newcastle to Leeds to Manchester to Birmingham and London, with our Strong Foundations course, our live events. The last chance to get some live revision in before the turn of the year. And it's always a great day, always good fun. We pack a lot into our time together. And that's Strong Foundations. If you go to tutor2.net/live, then you'll be fine. You'll get the details you need. And then in the spring, obviously, our major live events are the Grade Booster Tours. Lots of venues across the UK where we absolutely zoom in on key exam technique. So it'd be great to see some of you there. Places are booking quickly. So do take a look at our website for details. Let's make a start, everybody. We have, I think, 6 multiple choice questions on monetary policy. One or two quite challenging ones. So let's have a look at the first one. If you are watching live and want to post your answer in the chat window, please do so. What is the current Bank of England inflation target? Is it 3%? Is it 2%? Is it 1%? Or is it 2.5%? So the inflation target is set by the government, and the Bank of England has operational independence, and they set monetary policy with the aim of meeting the inflation target. So what do you think it is? And Sima has come in with B. Let's double check. It is indeed 2%. Now, the key point here is that inflation is highly unlikely to be 2%. It's currently 1.7, I think. But the 2% target is designed to act as an anchor for inflation expectations and a guide for monetary policy. Here's question number 2. In the summer of 2024, so just recently, the Bank of England announced a policy of quantitative tightening, or QT. What does this involve? So the Bank of England has essentially reversed quantitative easing, in part, and they brought in a policy of quantitative tightening. So which of those answers there involves quantitative tightening? What do we think? Increasing the base interest rate, selling sterling in the global currency markets, reducing the stock of assets held by the Bank of England, and selling foreign exchange reserves. Which of those best describes a policy of quantitative tightening? What do we think? Those people are watching live, do you want to have a go at that particular question? If you're watching on the replay, just press the pause button and think about it. The correct answer is coming up on the screen now. It is C, cutting the stock of assets. With quantitative easing, the Bank of England was buying bonds, typically government bonds, from commercial banks and giving them cash in exchange, therefore increasing liquidity. And the Bank of England added to its stock of government bonds. So essentially, the Bank of England, by the end of the QE period, was one of the major, if not the biggest holder of government bonds. So quantitative tightening is a reversal of that policy. They're cutting the stock of assets held at the UK central bank. Here's question 3. I like this question. It's a subtle question. So have a go at this one. Which one of the following risks could lead to a higher rate of UK inflation in the medium term, by which we mean somewhere between 3 to 5 years possibly? So it's not like a short-term inflationary shock. Which one of the following risks could lead to high inflation in the UK in the medium term? Is it falling energy prices globally? Is it a rise in cyclical unemployment? Is it lower aggregate demand in China? Is it stronger than expected global trade growth? What do we think here? Lots of influences on inflation, some of which are internal, domestic factors, some of which are external. And interestingly, there are 3 of those are external and one's internal. The right answer is coming up on the screen. It is D, stronger than expected trade growth. Quick explanation. If the world economy grows more quickly, if there's more trade, that's going to lift global aggregate demand. The UK will benefit from that in terms of GDP growth. But that could lead to higher prices for things like shipping fees, world commodity prices, so on and so forth. And that would be an inflationary factor for the UK. Here's question number 4. In the context of monetary policy, what is a liquidity trap? Now, quick warning here, this is a super important concept to understand whenever you get a question on monetary policy. So in the context of that, what is a liquidity trap? Is it when a central bank loses control of inflation expectations? Could it be when lowering interest rates has no effect stimulating demand, AD? Is it when inflation spirals out of control due to excess money supply? Or is it the inability of commercial banks to lend due to a lack of liquidity? What do we think? What's the best answer to that particular question? What do we think here? Well, the right answer is B, when lowering interest rates has no effect on stimulating the economy. This is a really key idea. It's a Keynesian concept. You see, when interest rates fall, they normally stimulate demand, but they don't necessarily do that. And even countries with near zero interest rates often have seen a very sluggish, stagnant, flat growth. And that's because monetary policies become ineffective. Now, when monetary policy loses its effectiveness, we say that the country is experiencing a liquidity trap. There's plenty of money and credit around. Money is cheap to borrow, but it's not stimulating the economy. We have a question on that in a few minutes. Here's question 5. What is the main objective of a contractionary monetary policy? And you have 5 options there. Sorry, 4 options. Question 5 has 4 options. What's the main objective of a contractionary monetary policy? What do we think? To reduce inflation by decreasing the money supply, to increase employment, to stimulate growth through lower taxes, to increase exports by lowering exchange rates. What do we think for question number 5? Okay, the right answer is going to be up on the screen. It is A. So a contractionary monetary policy is also known as a deflationary or disinflationary monetary policy. The aim is there is to squeeze demand to slow down the growth of money and credit by increasing interest rates, for example, or quantitative tightening to help bring down inflationary pressure. And here's our final multiple choice question in this session. Now, this is a really interesting question. Be super impressed if anybody gets the right answer here, either on live stream or watching on replay. Which of the following best explains the term neutral interest rates? The Bank of England, by the way, has been saying that they're looking to move towards a neutral interest rate for the UK economy. Is it the interest rate that minimises inflation? Is it the interest rate that neither stimulates nor restrains growth? Is it the interest rate that's set during periods of recession? Or is it the interest rate that minimises the fiscal or the budget deficit? Interesting question. Tom's come in with the answer B. Let's double check if Tom's right. Indeed. Well done, Tom. Yeah, this is a really interesting idea. It's the rate of interest that's not really stimulating demand to any great extent, but it's not deflating the economy. And of course, it's a tricky rate to establish. It's almost like an equilibrium interest rate, if that makes sense. And well, we know that interest rates are under 5%. It's probably lower than that, but maybe not much lower, maybe between 3.5% and 4%. Great answer, Tom. Well done. Just by way of context here, so we're going to move on to a few little questions. So what we have here is a key chart. The blue line there tracks the CPI inflation rate for the UK. Keep in mind, everybody, you're taking your exams in 2025. Most exams were set in the winter of 2023, autumn of 2023, 12, 18 months behind the exam itself. So really what's interesting there is that obviously we know inflation surged from 1% to nearly 10% on CPI during the cost of living crisis. Then we had the inflation falling back. And of course, the latest figures is now 1.7%. That chart doesn't yet show that. But that's inflation. Now, if we add on to the chart, the next slide shows interest rates, monetary policy, base interest rates. And of course, they went up from near 0 to 5.25%. They stayed there for a length of time, and now they've just dipped in July 2024. Bank of England cut interest rates for the first time. So my instinct is that there's going to be a question of monetary policy in 2025 of some description, and it could well be the decision by Bank of England and other central banks to cut interest rates. So bearing that in mind, here's a bit of context for you. So the bank cut interest rates. They've only cut it once so far. They're expecting to cut it again next week, actually, 2 weeks' time. So we're now down to 5%. Decision was driven by the need to address declining inflationary pressure, the fading impact of past external shocks, with wage growth and service inflation easing. The bank recognised the UK economy was losing momentum. GDP growth expected to slow below 2%, unemployment projected to rise. So the bank is aiming to support economic activity whilst being cautious to ensure inflation would sustainably return to the 2% target over the medium term. A couple of questions for you. Do have a go. And this is a 1-minute countdown clock. So if we get a good answer on the screen in the live chat, we'll post it up for you. But if you're watching on the replay, take a minute to have a go at this question. Can you identify 2 benefits for the UK economy of a period of lower interest rates? Let's start the clock. Well, Tom's asked a great question. We'll come on to that in a second. Simon said higher disposable incomes and cheaper borrowing for consumers and businesses. This is a great point. Simon, with your point about disposable income, I would be using a slightly different concept, effective disposable income, which I'll talk about in a minute. But a nice point there about cheaper borrowing. Tom O'Connor says it reduces the trade deficit on the current account as imports become more expensive and exports become cheaper in foreign markets. So a nice link there, potentially, with a time lag, Tom, between the cutting interest rates, the exchange rate, and the trade balance in the UK. That'll be a really good analysis there. Actually, the point that Tom's making there is something that very few students would include in their answer. So I'll talk a bit more about that in a second. Tom asked a prior question, if we can bring it up on the screen. Geoff, do you think we should maintain the base interest rate at 5% rather than bringing it down continually, which could counteract the disinflation? My instinct here, Tom, is that base rates need to fall. The Bank of England's probably a little bit behind the curve in terms of cutting interest rates. They've been uber cautious in keeping interest rates at 5.25 and now 5. Inflation in the UK has come down really quite sharply. A number of reasons for that, and that base rates probably need to be falling a little quicker than they have been. So my instinct is that by this time next year, you'll have taken your A-levels probably, Tom, and others. By the Christmas of 2025, base interest rates could well be 4%, and even lower, possibly even 3.5%. The Bank of England could move a bit more quickly because the main threats to inflation have, by and large, disappeared, although geopolitics has a part to play. What did I go for? I went for, actually, Tom's point is the second point, so we'll come back to that in a second. Stimulating consumer spending and investment. Yes, the interest rates going down means the cost of borrowing for households and businesses should, in theory, fall if market interest rates follow the Bank of England. Consumers more likely to spend, save less, perhaps. Businesses more likely to invest in new capital, in equipment, and innovation, both of which, of course, C plus I will add to aggregate demand. And Tom's point about the exchange rate is super useful and very relevant. Investors tend to seek high returns. So UK interest rates going down might lead them to move their financial capital, otherwise known as hot money, to countries with perhaps relatively high interest rates. That will bring down the sterling exchange rate, which might improve the price competitiveness of exports, again, improving the net trade difference. Both of which are perfectly valid answers, and of course we won't use an ADS diagram today, but you could use that. Thinking about evaluation, give me two reasons why cuts in interest rates might not necessarily boost AD and growth. Have a go. 1 minute countdown. So here's a chance to evaluate. The Bank of England is cutting interest rates slowly, but why might they not necessarily be a major boost to aggregate demand and growth? What do we think? So this really invites some evaluation about the effectiveness of monetary policy. Tom says it depends on the marginal propensity to consume of people in the market. Yes, indeed. A fall in interest rates, for example, increases the effective disposable income of mortgage payers. Okay. I'm about to buy a house. I'm going to take out a 2-year variable rate. Now, if that rate comes down, which I'm expecting it will, then my effective disposable income goes up. And then it depends on my propensity to spend from that increase in effective disposable income. So really key point there. Nice point, well made. Simon talks about lower confidence. And indeed, that is a point I have picked out in my suggested answer. And Tom talks about banks, commercial banks, Barclays, NatWest, Orcans. They may choose not to pass on the cut in base rates and bank rates. This is a really important point. Those of you watching, Tom took his A-levels last year. He's got fantastic background knowledge. This is a great evaluation point that commercial banks don't have to follow the Bank of England's base rate. Most banks do, but they don't have to because it's a competitive market in interest rates. Of course, if they don't pass on the cuts in base rates, consumers probably won't feel the full benefit. So I went with these 2 points, but thank you for those answers. I've gone for confidence and reluctance to lend. So during economic uncertainty, and of course we live in a time of great uncertainty still, both households and firms may be more inclined to save or use any gain in income to pay off existing debt rather than go to the bank or another lender and take out a bigger loan. And of course, many people are on fixed rate mortgages, millions, the bulk of people are on the fixed interest rate mortgages. So a short-term cut in base rates isn't really going to affect them. Indeed, many people this year are still having to pay higher interest rates because their fixed-term deals have come to an end in the last 6 months. And the second point is about commercial banks' reluctance to lend. If banks like Barclays and Lloyds are concerned about people's ability to repay loans, or if the financial sector overall has liquidity issues, we all have issues, but if they have liquidity issues, then low interest rates may not necessarily translate into greater credit availability. Both of these factors, low confidence and risk-averse banks, mute the impact of a base rate cut. But fantastic answers there from Simon and Tom, and we say thank you. Well, here's my last little subtopic today. So we do 20 minutes on monetary policy. Let's look a little bit more globally. This chart's quite interesting. It shows the UK bank rate, interest rate in the UK. That's in grey. The federal funds rate, which is the United States base interest rate, if you like, set by the United States Federal Reserve. And in the darker colour there, the ECB fixed interest rate. That's the interest rate, essentially the monetary policy rate set by the European Central Bank. And you can see, obviously, broadly speaking, that interest rates tend to rise and fall together, not always in sync, but pretty much. Now, as the world began to recover from the pandemic into 2022, of course, a new challenge emerged: inflation. Supply chain disruptions, surging energy prices, and pent-up demand all contributed to soaring prices in 2022. And this, as you can see on the chart there, from 2022 onwards, forced many central banks to reverse course, hiking interest rates to combat inflation and bring price pressures under control. We are still getting exam questions about the increase in interest rates in 2023. Here's my final question today for you. Again, it's just hinting at evaluation here. Can you please give me 2 reasons why there is a time lag between an increase in interest rates and a subsequent fall in inflation? They don't necessarily rise and fall at the same time. What are the reasons for a time lag? Start the clock, please. Now, lots of students in the exam say there is a time of evaluation, there's always a time lag, and then they press the full stop button. The key is to understand why there is a time lag between a tightening monetary policy and a fall in inflation, which we have seen in the UK. I think knowing why there's a time lag is more important than saying there's a time lag, because the best answers available will explain potential time lag. We're talking here, of course, about an increase in interest rates and a fall in inflation. So time lags, the go-to evaluation point for more than half of students, I guess, at A-level. Here are my 2 suggestions. First of all, it's kind of behavioural economics, okay? There's a time for borrowing costs to affect consumer and business behaviour. So Bank of England raises interest rates. Let's say many people and companies have existing loans, existing mortgages, credit deals, and those may be at fixed rates. Often people may fix for 2, 3, 4, 5 years. So for them, the cost of borrowing doesn't increase immediately. Tom comes in with a super point. Let's put it on the screen if we can, please. That behaviors do not change immediately. I love that phrase. People have a kind of behavioral inertia, and incremental rises in the base rate like that. That's kind of suggesting that fine-tuning of monetary policy does not have much of an effect. But if it continues to rise, then it does squeeze spending. So what Tom's suggesting there is that the interest elasticity of demand initially is low, but increases as interest rates continue to rise and with time. So people suddenly come to the end of their fixed rate mortgage and they have to renegotiate, and they suddenly see a big increase in their mortgage payments. What's like 1.5 million people have experienced that this year in the UK. Suddenly they're paying a lot more on their mortgage, and that takes a big chunk out of their effective disposable incomes. And then the other one is a kind of Keynesian idea. We're not all Keynesians, but I'm a Keynesian. Sticky wages. Many prices in the economy from which inflation is calculated, particularly wages and long-term contracts, they're sticky. They're not flexible. They don't respond to shifts in monetary policy. Firms set prices for lots of reasons: their costs, indirect taxes, market conditions, strength of competition. They don't necessarily look at the interest rate set by a central bank when setting prices. And this is a really key point. It's the kind of penultimate point I want to make today. The Bank of England does not determine inflation. Okay, the Bank of England sets the base rate of interest, one of thousands of interest rates, which can have an influence on inflationary pressure, but central banks do not determine the rate of inflation. The rate of inflation is a macro indicator, and it's a result of millions of micro decisions taken by consumers and businesses, ultimately. And in the labour market, wages are often quite sticky. They're determined on annual contracts. Does a firm have the profits to be able to afford to pay a pay rise? Is the government intervening through a minimum wage? Lots of influences, skill shortages, and so on and so forth. Many, many separate influences on wages other than the base rate of interest. So I think it's a really good idea, as part of the evaluation, to be nuanced and say, well, look, interest rates have an impact on inflation over time, but they don't determine inflation. The Bank of England guides the policy. It doesn't set the price of anything other than the base rate. So hopefully that evaluation was useful for you. There we go. Well, we've had 25 minutes today on monetary policy, and we tried to bring together, always try and find the intersection between year 12 and year 13 economics. Next week, we will look at fiscal policy and do some analysis and application and evaluation of that. So over this week and next week, a nice revision set for you on macro demand side policies. Thanks for joining in, as always. Some great answers. Simon and Tom in particular, absolutely superb. Stay happy, stay positive, stay curious, and see you sometime soon.